great investing or good investing is understanding the rate of change. And so if you can understand that change as it relates to what's happening with the environment and how companies are taking that on, there's the opportunity for good investing and creating value. This company was built for change, to understand change. And part of that is what I would have said a long time ago is we wouldn't have called it sustainability. We call it long-term active management. Today, we think that's synonymous with sustainability. It's one and the same. To be a good long-term investor, you have to care about the environment. You have to care about all the social implications that are happening around the world. Because if you're going to own and commit capital to a company for a longer period of time, you've got to make sure they're managing the business well. The good news about active management is we don't have to own every company, unlike passive. We get to actually select and choose those businesses that we think are worth owning. But in becoming a responsible owner, a lot of what's involved is engagement. So you are working with management, you are working with the boards, you are working to understand that company intensely well so that you can see, and it can be proved to you to have conviction that company is not only going to grow and develop and innovate and change, but that management is doing the right thing. And when they're not, you engage with them to either push back against strategy or push back against executive pay or push back on diversity of board. You can do that in an informal or formal way, but then you can also take it to proxy voting. When those shareholder votes come up to really make a stance, you can vote for or against a company on issues you think they need to do better on. I don't believe that the term ESG, environmental, social, and governance, will exist in 3 and 5 years in the investment community. And the reason it won't is because actually people will realize that this is true long-term active management. This is what our clients and our investors pay us to do, is to ensure that we factor in all of these important financial and non-financial issues about the companies we own. And if we're not doing that, then really we're not doing our job.
Hello, my name is Nicholas Paul, and I'm a member of the portfolio management team on the Mfs Mid-Cap Growth portfolio. Your trust and conviction in our strategy is greatly appreciated, and we will continue to work tirelessly on your behalf and invest in what we believe to be the best long-term opportunities in the U.S. mid-cap growth universe. So we are most interested in those companies where the durability of earnings growth is just simply underappreciated. Based on our current market outlook, what are some examples of where we're finding opportunities? Well, the first example I'll provide is in the technology sector. And here, demand for semiconductor chips has skyrocketed in recent years. And a simple way to think about this is that today, everything has a brain, so to speak, right? From computers to vehicles to refrigerators and in many other areas of daily life. And it's here we are looking for companies that feed into this area of the market, or more specifically, the companies making the equipment needed to build out the so-called semiconductor foundries and make semiconductor chips. Here we own names like MKS Instruments and ASML, both semiconductor capital equipment companies that again are instrumental to the success of larger semiconductor manufacturers. At the same time, we also own software companies like Cadence Design and Synopsys, which develop the basic building blocks and software used widely across the entire semiconductor industry. Now, another area where we're finding exciting opportunities today is in healthcare. In healthcare, you'll hear a lot of talk about biotechnology and drug discovery. The problem is it's extremely hard to consistently invest in these companies because the outcomes for these businesses tends to be binary, right? So you're either successful in developing that 1 in a million game-changing drug, or you're not. So what we've been doing here is investing in healthcare industries like life sciences and tools and healthcare equipment that the biotech and drug discovery companies actually turn to when trying to create the next miracle drug or specialized procedure. Here, names include companies like PerkinElmer, Steris, Massimo, or even a name like Charles River Labs that's contracted by the pharmaceutical industry to independently run tests for FDA trials. So that's just a few examples of where we're finding exciting opportunities to invest today. Receding COVID cases, the tentative reopening of sectors and geographies in the US, broadening distribution of the coronavirus vaccine, as well as fiscal stimulus and a great deal of pent-up demand by the consumer has sent inflation expectation higher in recent weeks. Now, this has led to higher bond yields and called into question the sustainability of the valuations of longer duration growth stocks. Now, the sharp rise in yields and inflation expectations has in turn prompted investors to focus on parts of the market that had underperformed for much of the last decade. So in particular, value and cyclical stocks. So what does that mean for our long-term outlook for US growth companies, and in particular, US mid-cap growth companies? Well, if you actually look at US markets by industry and look at which companies are growing at above market rates versus those that are not, and where profit pools are going, I think this provides a helpful sanity check on the opportunity for growth stocks going forward. And it makes sense why certain more technology-oriented or growth-oriented companies are winning and very well may continue to win over the long term. So as I think about the long-term opportunity, I really want to focus on areas of growth and innovation across industries. So for example, in autos and housing, things like electric vehicles, the Internet of Things, smart elevators, connected homes. In consumer staples, healthy eating and e-commerce. In energy, profits are going to solar and other alternative sources of energy. In financial services, all the growth is coming from fintech. In healthcare, areas like biotech, telehealth, or next generation tools. In industrials, very similar to autos and housing, all things digital, Internet of Things. In leisure, think about cord cutting or streaming video on demand, video games. And in retailing, think about e-commerce or digital, omni-channel, or more direct to consumer. So all of these areas still tend to favor growth companies over the long term, and I remain very positive on the outlook for growth stocks. So what will we do? We're going to remain focused on companies that we believe can generate above average, sustainable earnings growth over full market cycles and not get caught up in those companies or areas of the market that have recently benefited from higher expected GDP growth and higher rates. So for example, cyclicals or commodities or financials, because these companies may very well lack the sustainable growth characteristics that we prioritize. So in closing, thank you very much for your time today and for your interest in the MFS Mid-Cap Growth portfolio. And I hope you found this video helpful today. Thank you.